Okay, well, Jahangir Aziz is now joining us, Global Head of Emerging Market Economics at JPMorgan. Jahangir, it's always a pleasure. Great to have you with us here on the program. What's going on in the world, Jahangir? It seems like, a study in contrast. Things in the US are so good that it's actually turning out to be bad for markets. And in China, it just is bad. So two engines, two largest economies, are pulling in the opposite direction. What does it mean for markets?
So I think the market is slowly getting into that shift or increasingly realizing that probably there should be attention to this growth shift that is taking place, where, as you pointed out, the US economy is chugging along. We had a call of recession, which we took off. So we are now looking at a baseline of a soft landing taking place. If you look at the Atlanta Fed's nowcaster that came out, I think last week, or just after the retail sales number came out, it's showing a 3Q growth that's now running around 5% of the nowcaster. We don't have 5% for 3Q growth for the US. We have about 2.5%. On the other hand, it's not just that, China is languishing. On top of that, you have serious concerns about the euro area. If you look at the IP numbers coming out of your euro area, they're terrible numbers. So I think that, it's not just that China, one engine of growth is sputtering. It is that euro area is also sputtering. US is the one that, is essentially chugging along, probably going to avoid, a hard landing, and as a result, all of the rate cuts that people had sort of priced in is being pushed back. The growth differential between the US and the euro area and US and China is actually hardening the dollar. So we have a situation where not only are long end of the curve moving up because the rate cuts are being pushed back, the curves are steepening, and on top of that, you have the dollar hardening, and the combination of all of that is essentially working on the equity market in the US, for example, at this point in time. But I think that, if you take out China and euro area, and even though these are large negative shocks to the emerging market economies, if you look at the emerging market economies, they are still continuing to show this remarkable resilience that they have shown throughout this year. And almost all my country economists are actually pushing up growth forecasts for most of these economies. So I think that, you're probably entering into the world where the US and emerging market ex-China is going to do reasonably well, even though the background against which they're doing well, which is, euro area and China, pretty much in a very sluggish zone, is going to be the big headwinds.
Okay, but Jahangir, hi, good morning. The worry also stems back home, right? I mean, the retail inflation at a 15-month high. Now there are talks of perhaps the RBI hiking rates once again, and rate cuts getting pushed way back into, way forward into FY25. What is your view of how things could move back home?
Look, you have El Nino, you have a monsoon rain shortfall, and if you don't expect agricultural prices to rise, I mean, you must be living in a very different reality. So yes, agricultural prices will rise. Look at the print. Yes, the headline surprised us, but look at the core inflation. It actually went down from 5.4 to 5.2, if my recollection is right. So I think that, you are getting the benefits, and I've spoken about this in the past, you are getting the benefits of very strong export price deflation that is coming out of China. And that is keeping not only goods disinflation down globally, but it's also, keeping core inflation down in India. And I think that's going to continue because, China deflation is probably going to be there for the next 3-4 months. But, RBI clearly is going to look through this rise in agricultural prices. I think the concern for them will be that does the rise in headline inflation, does the rise in agricultural prices get passed on to core inflation? I think they'll wait for that. But waiting for that is going to be a long period of time, because waiting for that means that both the Kharif crop and the Rabi crop has to actually be normal. And that is the reason why I think that, the rate cutting cycle for the RBI probably gets pushed back into calendar year 24, maybe in the middle of calendar year 24. But I think the benchmark for a rate hike, just because agricultural prices are rising, I think that's a very, very high benchmark.
Hi, good morning, Mr. Aziz. So the RBI, rate cuts, I think an optimist would say end of this year, but that seems, very far-fetched going by the data points that we're getting. What about the Fed, Mr. Aziz? I mean, what kind of trajectory are you looking at? Because the retail numbers are looking so good and, very, very strong. But how many more rate hikes do they have in store?
So I think the India issue is much simpler. So we also had a rate cut in the fourth quarter of 23, which we pushed back into 24 because, on the grounds that the RBI is going to wait for agricultural prices to normalize. But the Fed problem is probably much more complicated, given the fact that retail sales, and look at the IP numbers that came out this morning. I mean, both of them were significantly above what expectations were. And I think that even though the benchmark for a September rate hike is still high, and we sort of don't think that the Fed is going to hike, but remain on hold for an extended period of time, again, letting the long and variable lags to work through. I think even though that is a baseline, the risk still remains that after waiting for some period of time, if indeed you do not get inflation down to your comfort zone of 2.5–3%, and non-farm payroll numbers keep chugging along at above 100, 150, I think there is a very good chance that sometime in 24 you might see the Fed rehiking. But I don't think that the Fed is going to hike, without pausing for a considerable period of time to allow the market and allow this banking sector and to allow the economy to actually absorb that 525, 550 basis points of rate hike that they have done. They have already talked about that, and I think that they need to let the economy actually adjust to that.
It's been incredible, isn't it, Jahangir? 500 basis points, and still, as you said, the economy is chugging along. But these things work with a lag, so maybe it'll show up.
Yes, that's basically the problem. Yeah,
so we're in the transition kind of period.
It's not just the lags. The lags are variable, right? So the lags could actually work later in the period rather than in the first 4 quarters. It could work much more strongly in the 6th to the 8th or the 12th quarter. And that's the problem with these kinds of monetary policy hikes.
Yeah, no, absolutely. Got it. Got it. So emerging market and US are fine, which means markets there perhaps will be fine. Ex-China, ex-Europe, right? We can live with that.
That's correct. Well, I think the real worry is Europe and China, and clearly there'll be spillovers, right, from Europe and China. It is going to slow down emerging market because we depend on that. We depend on all 3 economies to keep our economies going. So I'm not saying that the emerging markets growth is not going to slow down, but the growth is not going to. It's not going to be a cliff that they're going to fall over, which is what we were afraid of even 4 or 5 months back.
All right, Jahangir, we leave it at that. Thanks a lot for joining in, and have a great day. So emerging market economies are showing resilience, but the real concern stems out of Europe as well as what's happening in markets like China, with the economic data being weaker than expected. All right, let's do one thing. Let's take a quick break. On the other side of the break, our entire research team will be with us to give us the list of top 10 stocks that we need to watch out for today.